In December 2025, the European Council backed the ECB's plans for a digital euro. In February of this year, the European Parliament also backed these plans in an amendment to the ECB's annual report, despite some resistance and marking a turning point in how the Parliament has positioned itself in that debate. By March, the parliamentary rapporteur, who had long been opposed to online digital euro functionality, also supported the project and now is fully backing it. So this means that by now there is a chance that by the summer, the European Parliament will formally approve the digital euro plans and then start to negotiate with the European Council on the final details. And against that background, our objective is to take stock of these preparatory plans and asking questions like, what is the design of the digital euro? Do the objectives of the project make sense? Do the design choices are likely to help us achieve those objectives? How does the project fit into the broader payments landscape, which, as we all know, is changing rapidly? And what should we expect for the future? My name is Dirk Niepelt. I'm a professor of macroeconomics at the University of Bern, and I lead CEPR's research and policy network on fintech and digital currencies. And I'm very happy to introduce to you our distinguished set of panelists for today's webinar, who are in alphabetical order. Jean-Pierre Landau from Sciences Po. Jean-Pierre has a distinguished career in public service, including at the IMF, the World Bank, the Ministry of Finance, the EBRD, and the Banque de France as deputy governor. Then we have Isabelle Mateos y Lago. She's the group chief economist at BNP Paribas. Isabelle has worked in the private sector and in the public sector. Before joining BNP Paribas, she's been at the IMF, and she has held various positions at BlackRock. Then we have Éric Monnet, professor at the Paris School of Economics. His research mostly in the area of questions where he uses historical data to think about financial markets and central banking. Éric has been at Banque de France before joining Paris School of Economics. Then Lucrezia Reichlin from London Business School and Bruegel. Lucrezia has held many different positions, including as the Director General of Research at the ECB. And finally, last but not least, Harald Uhlig from the University of Chicago. Also a macroeconomist, Harald has been at Princeton and Tilburg and Humboldt University in Berlin before joining Chicago. So I'm very happy that we have this excellent set of panelists to debate the issues surrounding the digital euro today. We have agreed to start with a round of introductory remarks by each of the panelists, around 4 minutes. And then we'll try to come back to these initial questions I posed and dig a bit deeper in trying to unpack. We have a Q&A channel open, and we try to have a view on that. Each of the panelists hopefully can have a look at that and then identify questions of interest. So we try to do our best. And also for those of you interested online, this is going to be recorded and eventually will be available on YouTube. So with these preliminary remarks, a very warm welcome to all of you again. And we start with Jean-Pierre's introductory remarks. Jean-Pierre, please.
Thank you, Dirk. It's a privilege to be here. 4 minutes, 4 remarks. First remark, I think we all agree on the relevance and necessity of wholesale digital currency. In the digital environment, it's necessary to allow the central bank to perform its function as a major actor in the wholesale payment and settlement system, and in the future as maybe a major actor in the tokenized chain of finance. So the debate today is about the retail digital euro, and it's been a very controversial one. So for the sake of clarity, I will assume that we live in the future in a total digital environment, that cash has disappeared. Cash is the only public money to which we have access as household. And the question, therefore, is whether we can contemplate a situation where, as you and me, as public-private households, we live in a world where there is no public money which is accessible to us. And that's a situation which has not existed in the last 3 or 4 centuries. So it would be a total innovation. The coexistence of public and private money in the hands of households would be finished. And that would raise, of course, a fundamental question of monetary architecture. There is a sizable chunk of opinion which says we can live with that. And I would signal that this opinion is based on, I think, 3 assumptions implicit, which deserve to be discussed. So my second remark, let's look first at bank-based environment. Let's say we live in an environment of tokenized deposits are tokenized, but the system remains fundamentally bank-based. The assumption there is that we can replicate the safety, stability, and information sensibility of public money through a mix of regulation and mechanism. In that environment, we would have central bank money to ensure transfer of deposit between banks and ensure the singleness of money. All deposits are equivalent because they can be transferred from one bank to another. We have deposit insurance, we have prudential regulation, we have lender of last resort, and the assumption is that that mix of instruments and mechanism is sufficient to ensure a quality of private money which makes it equivalent to public money which has disappeared. And I think there are 3 reasons to question that assumption. The first reason is historical experience. We all gone through 2008, where there was at some stage in November 2008, a general doubt on the value of private money. There was the quite real possibility of a run of all deposits. My colleagues, former central bankers and I, we all gone through that experience where we got phone calls from friends in top banks asking to open for themselves accounts at the central bank. There are many, many reports on that. So the doubts were very general. Okay? So it shows that the possibility of a general panic on bank deposit, a general doubt on the value of private money, is a real one. The second reason is more subtle. Many central bankers make the point in their speeches, the public assume that deposit and cash are equivalent. That drives their behavior. So they implicitly assume that deposit can be converted into cash, even if that doesn't happen often, less and less often, and even if there are many physical and regulatory frictions. So we are in that very strange but very important situation where the equilibrium of money depends on an assumption of convertibility which is not frequently tested, but when it's tested, it can be very dramatic. So if I can have, and so the pure existence of public money, even when it's not used, is an essential contribution to the stability of private money. And if I can make an audacious comparison, it's like a little bit like nuclear deterrence. You have an instrument, you hope you won't use it, but the fact that that instrument is there is essential to the stability of the system. And the third reason why we challenge the assumption is even more fundamental. Let's take deposit insurance. Deposit insurance is a system which ultimately the government guarantees your deposits. What does it mean? If we only have private money, it means government guarantees your deposit through other deposits. But if you have a general doubt on bank money, that guarantee is moot. And in general, I think any claim on the government is implicitly assumed to be settled in public money. When we hold a government bond, we assume that we will be paid back in public money. So if as household we don't have public money, what does it mean for the safety, the integrity, and the pricing of government bonds? So I think we have been a little bit negligent in thinking on those issues. And those three questions make me question the assumption that you can replicate the safety and the intrinsic characteristic of public money by a mix of regulation and instrument applying public money. Third remark, if I move now to a non-bank environment, like if we live in an environment where payments and money is made of stable coins with no relationship to a bank-based system, then of course the situation is much clearer. We are very close to the situation where we were in the 19th century. We have private money instruments circulating with no anchor into any kind of public money, and we know that it's bound to trigger periodic bout of instability and run, and that the whole integrity and stability of the system will be at stake. So I guess fundamentally, if we move to a system of stablecoin, and if there is no digital euro, then the pressure will be enormous to grant a stablecoin issuer access to central bank money, to give them at least the singleness and the convertibility to ensure that they are comparable, at least with bank deposit. So I'm not sure it's the interest actually of the bank. If the singleness of money is ensured in the future by giving non-bank access to the central bank balance sheet. So we have two alternatives here, which is two possibilities here. Either have a digital euro which the holders of stablecoins can access when they have doubts on the value of the stablecoins, and that stabilizes the whole system, or we give issuer of stablecoin access to the central bank balance sheet, and that's a very totally different game, and I'm not sure that the bank would be very, very happy in such a system. Last point, what kind of digital euro do we want? I think the current plans, which are based on a narrow cap on holdings, if I understand well, are very paradoxical. And they implement a sort of reverse specialization of money, where public money is specialized as a payment instrument, where it has no comparative advantage. Private sector is much, much more efficient than public in operating payment. And private money with almost unlimited holdings, at least 150,000 euros guaranteed deposit, is specialized as a store of value with a public guarantee. I have big difficulties understanding the rationale behind this specialization, and I think it's quite actually a reverse specialization. So I would advocate, if it's still time, for a different system. There has been a tiering system. I'm almost finished. There has been a tiering system which has been discussed, where different holdings of digital euro would pay some fees, where large holding would pay large fees, and that would be the price of safety. And I would advocate reconsideration of that system in the future for digital euro. I think it would be much more rational and much more stabilizing. So the future I envisage is twofold. First, having a digital euro with a tiering system, and second, of course, a very robust set of arrangements between the central bank and the banks to ensure that they are protected against the volatility of their deposit and any phenomenon of currency substitution between their deposit and the digital euro. Thank you, Dirk.
Thank you, Jean-Pierre. So there's many issues we're going to raise later on concerning the broader landscape, monetary architecture, and etc. Isabelle, you're next, and you also get now a bit more than 4 minutes, unless you just need the 4 minutes, but otherwise you get 6 minutes as well.
Thank you, Dirk. I also have 4 points, and I'll try to stick to 4. So thank you very much to CEPR for putting on this panel, and it's a privilege to share the stage with such distinguished co-panelists. So I'm coming at this from the standpoint of being enthusiastic about digital finance and being enthusiastic about the euro, and I'd love for this to evolve in a way that both can continue to thrive. So first point, I think, and I agree with Jean-Pierre and what I think we will hear from some of the others, that digital finance holds a tremendous amount of promise, both for wholesale transaction and for retail transactions, and also potentially to accelerate the savings and investment union. And it's great that the Eurosystem is on the front foot on deploying this, making this available. And here the clear priority, to my mind, is the development of the wholesale digital euro. This is on track to launch in Q3 of this year. The Eurosystem is really, as I said, at the forefront of central bank developments there. It's really exciting, and it's important to set the foundation of a financial system that is able to evolve into a tokenized one. So this is huge, and it really deserves high priority from the ECB. Moving to the retail digital euro, and I come to my second point here. You know, as the Americans like to say, if it ain't broken, don't fix it. And the starting point that we have is one, the Eurozone has a very efficient payment system. I'm just back from a trip to the US. I mean, you have to marvel at the inefficiency of the payment system over there, whether it's, you know, interbank transfers, you know, credit cards, you know, I mean, it's just like we have a great payment system in Europe that is trusted, that works. So let's make sure we don't damage that. Secondly, we have a well-working, well-established, trusted two-tier system with a combination of public money and private money. The share of public money, that is to say cash, you know, banknotes and coins, very stable, around just under 15% of total money, meaning the vast majority of money available to individuals is commercial bank money. That's been working really well. No reason to want to change that. And third, as also Jean-Pierre noted, in Europe, we have an economy that is predominantly, overwhelmingly financed by banks. 86% of credit to households, 56% of credit to corporates, 42% of sovereign debt is financed by banks. And banks finance all this lending overwhelmingly through deposits. So it's not to say there aren't other systems that can work, but we need to think very carefully about not destabilizing this model, particularly at a time when Europe is facing massive investment needs that it's going to need to finance one way or another. And what I mean to say by this is some of the design options in the rollout of the digital euro have the potential to destabilize all this well-working system. And it seems to me really important to be very thoughtful in the design and in the process of the rollout to make sure that we don't break this. Okay, third, one of the issues that has surfaced in the discussion on the objectives of the digital euro is sovereignty. Now, recently, the ECB has walked this back a little bit and has been framing the goal much more as Jean-Pierre was framing it, that, you know, we're moving to a world where maybe cash, you know, physical cash will disappear and we can't afford to not have some form of public money available. I don't have a problem with that. Nevertheless, this issue of sovereignty is one that has resonated with the public, with, you know, European MPs, and I think for European citizens, yes, they've realized that we don't have a fully sovereign European payment system because we rely on a lot of American technology to make our payments. It's true, it's a problem, but it's a problem that is on way to be resolved through private sector initiatives, and in particular the European Payment Initiative, within which 15 European banks are putting together a sort of native payment infrastructure that will, you know, that is already reducing reliance on the large American firms that still dominate payments. So there is no need for public money to solve that particular issue. The private sector is working on it. Maybe both can contribute, but, you know, the sovereignty, in my mind, is a weak argument. And ultimately, as long as we all have, you know, American-made phones to pay in shops, that sovereignty problem will not be fully eliminated, whether the underlying currency is a digital euro or a commercial bank euro. Okay, fourth point. I'll be very quick. Trust is something that is critical to money, as the historians on the panel, I'm sure, will agree, and it's something that is built gradually but can be lost very quickly. Now, the whole retail digital euro project is a huge undertaking, industrial scale undertaking involving not just the public sector, but private payment operators, banks, etc. It's very complex. There's lots of ways and levels at which it can go wrong. And one would think that a phased implementation with scope for learning by doing, learning how all the parts of this ecosystem adapt to this could make sense rather than trying to go with a big bang, getting it wrong, and trust being damaged from the outset. So these are my 4 points.
Thanks very much, Isabelle. And we move on to Éric, please.
Hello, good morning. Thank you very much, Dirk. So I will try to be brief as well. An important note is that I will speak only about the retail digital euro. I mean, as Jean-Pierre and Lucrezia, I mean, we know that the wholesale digital euro is also a very important issue. But let's stick here on the issue of the retail one. So why do we need this retail central bank digital currency? I mean, as it has already been said, I mean, I can emphasize 2 points. I mean, the first one is really this idea of public service. So providing a means of payment of last resort, what I mean that, which is, in cases of, it can be either for individual shocks, people that can, from whatever reason, can be included for the banking system. It's pretty low rate of people in Europe, but it can happen. I mean, they all can access a public means of payment. But it can also be for global shocks. I mean, Jean-Pierre talked about like many disasters that can happen. It's always very important to know that there is always a resilient means of payment ensured by the state. This is the first reason, what I call the means of payment of last resort. And the second reason is this idea of competition between private and public money, which has already been highlighted before. And on this competition, I mean, what the idea is very simple, just to say that, I mean, as we know, money creation is a privilege of the state and also of private banks. And having both private and public money is a way to avoid that the private privilege of money creation does not become a rent. Okay, so it's about like putting a bit of competition so that it does not become a rent from this private banks, but also, of course, we don't want that to be a crowding out effect. Okay, so it's all reaching the right balance between competition and avoiding crowding out. So this has been done a lot in history, as Jean-Pierre and Isabelle said, obviously for banknote, and this is the main reference point in all these discussions, but also for different schemes that I often, I think, neglected in all this discussion. I mean, the main one was actually postal saving banks, I mean, which are very important in history, which were a kind of narrow bank, which it was very important for financial inclusion in Europe. It still exists in many emerging countries, where people will have a safe deposit, which are different from the banking system, and which was associated with a means of payment that was very important in the history of means of payment, which was the postal checks of postal zeros. So it's not only through the banknote that there was intervention of the state and generally in providing some form of public money. And if you look at many European countries, you have to wait until very recently, actually until the 1880s, for commercial banks to become dominant in means of payment or even sometimes in holding accounts of households compared to some saving banks and postal saving banks. So it's not only banknotes in history. But the last point is that when we're talking about these all discussions, and as you see, I mean, it's all about reaching the right equilibrium, the right balance between competition and complementarity. Is all the devil is in the details, as always. So let me go into the detail and by highlighting the 3 important trade-offs. So the first one is that we know that if digital money really wants to replace cash, it needs a fair amount of privacy. And people want it to get private, to be sure that they can have, just like some simple transfers that they can do with a bit of privacy. So we want a bit of privacy, but we don't want the digital euro to become a way to facilitate money laundering and so on. Okay, so it's the first trade-off between the two. And in the details, I mean, it's very important because it goes in very important things, so that who is going to hold a wallet in digital euro, an account in digital euro, residents, but which kind of resident, which kind of visa, and so on. We know that today, I mean, even it can be a very popular argument, but I mean, a lot of immigrants, a lot of sectors in Europe are functioning on immigrants, which do not always have an official permit to work. They are using cash. They will probably be using the digital euro. It's important for the economy. It's privacy, but we don't want this to become extremely large. So, this is the kind of thing that are going to be very important what kind of visa do you need to get access to a digital wallet? The second trade-off is between this wide access and potential disintermediation. So this has been discussed a lot with the ceiling accounts. What would be the maximum of this digital euro account or wallet that people can hold? But it's not only about the ceiling. It's, for example, about children. If all the children of the family can hold an account, and the parents can put their money in the account of the children, then the ceiling is much higher than before. So when you think about children, it's not at all a minor issue, and it has been very little discussed for now. And in this way, I think I really go with Jean-Pierre Landau that when you think about introducing children in all this picture, it's here that the tiering system can become much more actually flexible because it's very difficult to put a ceiling for children at what age and so on. And the third trade-off is about we want sovereignty. We want this digital euro to be really sovereign, but on the other hand, you also want complementarity with private payment provider, including, if you don't want to be a fully closed economy, some potentially international one. But we don't want to have US big tech to benefit from the digital euro as a point of enter in the payment, and that actually it will go into that. So here again, it goes into the details. There have been a lot of recent debates recently between banks and experts and the Parliament and Council about, for example, the open funding. Whether you can have a payment service provider that can directly get the money from another payment service provider on this. So it's a very important issue of to be able exactly we're going to be able to transfer from one wallet to the other one, and to be sure that indeed, this remains a sovereign technology and is not going to be absorbed by US payment tech companies. So I will stop on this.
Thank you very much, Eric. Thank you, Eric. And Lucrezia is next.
Okay, hello everybody, this is great. So the ECB has emphasized three objectives. Okay, so preserve European strategic autonomy in payments, reduce rent extraction by home and foreign payment service providers, and monetary anchor. These are the three objectives. So are these objectives reasonable? That was the first question that we were asked to answer. And yes, I think these objectives are reasonable. But these objectives do not necessarily require a retail CBDC, and definitely not with the current design. Let me be clear, we can discuss an alternative design, which is probably what Jean-Pierre or Eric have in mind, which is not on the table. It is not what's been discussed, and in my view, is never going to be happening because in Europe, we are extremely pro-bank, and all our regulation is designed to defend the banking system as it is, okay? But it's an interesting discussion, largely academic at this point. Now, so the main point is why I don't think this we necessarily want a retail CBDC. I'm not against a retail CBDC, but why is not necessarily the answer to the stated objective. The first point is that the money and payments are not the same thing, okay? Money is what settled obligations, and payment are the mechanism that transfer claims. And historically, the norm has not been to have an entirely public sector payment system. Actually, historically, payments system have largely been run by the private sector, while the public sector have provided oversight and crucially, settlement in central bank money, which is something that everybody recognizes as being very important. So payment infrastructure have largely been hybrid. I think, Eric, you're the historian here, but I've read a lot of history of money. And what I understand, even from my kind of non-historian point of view, is that from Venice to Amsterdam to Genoa in the 15th century, and later on, these were always hybrid type of system, combining public authority with private activity. And the way in which these things were combined, it really depended on the political structure of the city. Okay, so Venice more public, Geneva more private, and so on. So this over time has evolved in what we know today, which is this system in which we have the private money dominates payments and public money anchors trust. If we come to sovereignty, I mean, sovereignty has never meant controlling every payment instrument. It has meant controlling the unit of account and the settlement asset. And this is the anchor, what they call the anchor, in my view, sits at the wholesale level where the transactions are settled in central bank money. And this is why, to me, priority in the policy agenda is to speed up with the wholesale project that the ECB has, the APIA project, because this is going to be extremely important to provide the interoperability with private assets, with private tokenized money that is actually developing very fast. And okay, second point, what does it achieve to achieve these goals? So the objective is payment sovereignty. I think the main levers is basically institutionals, regulations, and so on. So we have examples like Brazil and India, which have built sovereign payment systems without retail CBDC, but treating payments as public infrastructure, enforcing interoperability, combining public governance with private provision. So why can't we do that in Europe? Well, we cannot do that because we have an institutional fragmentation, which is our, problem for everything we do. So if this is a problem, let's fix it where it is, okay? So I don't think the CBDC with this design in particular will provide that kind of unified payment system in the tokenized world. And then this leads me to my last point, which is, again, about sovereignty and where the challenge really is. While we are discussing CBDC, a lot of stuff is happening. And not just the development of new payment technologies, but we are actually seeing, a very fast development of private digital money, often dominated in US dollars. And actually, I've looked at the data on the penetration of dollar-backed stablecoin in the euro market. And this is quite scary, I think. So this is where the main competitive pressure comes. In fact, even if you look at Visa, I mean, what Visa is doing is integrating the support for the development of dollar-backed stablecoin in Europe. So this is what we should worry about. And, and I mean, what I think is the danger here is not the retail dollarization. It's not, the African or the Argentina model, but it's the infrastructure dollarization. So this is not just about currency substitution. It's the danger that finance will develop around a dollar stablecoin as liquidity, collateral, settlement asset. And, this will mean that there will be a parallel infrastructure which is completely outside the regulatory perimeters and will be denominated in dollars. So I'm out of my time. So I think there are things we can do to face the main challenge. And definitely what we are doing is not the right thing, okay? Because the CBDC retail is not the answer. Maybe we want it, but this is not the answer for this main challenge. And the regulation that we have, which is MiCA EU regulation, is ill-designed, in my view. But, maybe I will talk about that in the second round. And I think we have to think about what is the architecture that we want in the era of tokenization. We cannot prevent private money to develop because there are always being competition between currencies, and but we have to embed it in a system that we can protect. And so I think this is the real discussion that we should have, and I don't see enough of that around. And I'd like to specify how I think we should do things in the second round. Thank you.
Thank you, Lucrezia. And it's Harald.
Yeah,
and
thank you.
Harald,
Thanks,
you have some slides, I think.
Right, yeah, so let me find the slides here. Yeah, so thank you for letting me be part of this distinguished panel. I'm very pleased proud to be here. So let me make a few remarks. So from the outset, let me just say I'm enthusiastic about the introduction of the digital euro. I think it should happen. Why am I enthusiastic? Well, the future is digital. The digital euro is going to either not change things or improve things here and there, and there are exciting opportunities. So let's do it. It's not going to solve all problems. Let's be clear, right? I mean, maybe not all the objectives that the ECB has stated will be solved, but it's exciting going forward. We should do it. Now there are challenges, and that's what I want to talk about. The digital euro has been hamstrung from the get-go. So the ECB has insisted, after some discussion, that the ECB should be like money, at least a certain fraction within the crowd they're discussing that said it should be like money. But money is a 10,000-year-old technology. Why, in a digital age, would you tie yourself, if you make a technology innovation, to something that's a 10,000-year-old technology? Run with modern possibilities. Now, so they have limited the digital options. I should say, to be fair to the ECB, and I applaud the people on the inside who have apparently pushed in that direction. I used to think that the digital euro would be introduced without programmability. That's not true. There will be programmability. There will be possibilities to program automated payments and escrow accounts and smart contracts to some degree. And that's a relief to me. I think that's fantastic. It's, I can only, I don't know who did this inside the ECB. I can only, applaud them and thank them that they pushed this through. It's not full programmability, but at least it's a start. So I'm very happy about this. But from my perspective, more could have been done. But maybe the main point is it's not paying interest, and they're holding limits of 3,000 euro, and you have to wonder why. For example, banks earn interest on their digital euros. They're just not called digital euros, they're called reserves. The ECB is paying interest on those, but the taxpayers who hold digital euros don't get interest. I expect this to blow up. I mean, if a journalist listens to this is an easy op-ed to write up and put up on the front page. Taxpayers have to, don't get interest, but bankers do. I mean, that's, how can that be right? Now, also the holding limits of the 3,000 euro limit the usability of this. Imagine you want to make a large transfer. You can only hold that for a certain chunk of time on your digital euro account. Ultimately, there's no good reason for that. Now, I suspect the reason that these hamstrings are there, these constraints are there, due to heavy lobbying by the traditional lobby, the traditional finance, banks, and so forth. They're very powerful, but the ECB is ultimately not there to work for the banking system. It's there to work for everyone, right? And the banking system, is. The market should serve the people, not the people the market, and I think that's important to keep in mind here. So, I think eventually, I hope that we will push it back against this. So there are really two roads forward here. It could be that the digital euro is for nerds only, similar to the Susan B. Anthony coin. I pictured this on the right-hand side. So the top is my version of the digital euro. On the bottom is the Susan B. Anthony coin, which is legal tender in the United States. I've never seen it, and you can look up why. Or it could be successful, but then these restrictions are more like a Trojan horse, and they're going to be relaxed over time. So the ECB really has to make a choice. Do they want this to be a Susan B. Anthony coin, or do they want this to be widely successful? And if it's widely successful, these restrictions will have to go eventually. Then we have a new financial system, and that needs thought, and needs a lot more thought than we have given it so far. So the big fear is that what we are seeing is disintermediation. So, we talked about this, banks, play a crucial role of intermediating between liquid household deposits and liquid investment projects. Diamond Dipwick have formulated this famously in the 1983 paper. Now, if people flow out of deposits into digital euro accounts, which would happen if it's successful, right? If it's not successful, you don't have to worry about it. If it's a Susan B. Anthony coin, let's forget that. But if it's successful, there's going to be pressure of households moving away from deposits and into digital euro accounts. And of course, banks are scared of that, naturally. Now, that won't happen unless the digital euro is sufficiently unattractive. That seems to be some that advocate for that in the ECB, or the households somehow reinvest in banks. that's the route that Duffy proposed, or, and I think that point is really central, the central bank refunds banks or projects. That's a point made by Brunner Meyer Niepelt in their JME paper, wonderful paper, and it really established a crucial benchmark of how to think about all this. You know, in this picture here, as the banks lose the deposit base, but the central banks gets more CBDC, you have to think of what has to happen on the asset side of the central bank. And the central bank ultimately can refund the banks. Now, how to do this? There's a lot of devil in the detail, and you have to think that through very, very carefully. But that should be the benchmark at which we should orient ourselves. And then this fear that we get this disintermediation would be off the table. But it requires a lot of careful thought. Now, in my paper with Linda Schilling and Jesus Fernandez Villaverde, we've thought about this last option, where you get this refunding of this intermediation process, and actually thought it all the way to the end. So we took an extreme stance. Obviously, that's not where it ends up. So the truth is going to be somewhere in between. Where we imagine households no longer hold any deposits. They only hold the digital euro or central bank digital currency, CBDC. And the central bank does all the diametric intermediation now. Now you could put in institutions in between and enrich this structure, but for the formal analysis, this doesn't matter all that much, even though, of course, for the implementation would be hugely crucial. And what we show in that paper is that what you then get is a CBDC trilemma. You might think that if everybody holds digital euros rather than deposits, that this will make the banking system super safe. That this is like the ultimate Chicago plan, right? Everything is backed by central bank reserves, wonderful narrow banking to the T. But that's not true. The tension between short-term and long-term liabilities that Diamond Dipping pointed to is there still. It doesn't go away. That's just a fundamental tension in the financial system. It's true the central bank can always deliver on its nominal obligations, but runs on a central bank can happen. So what's a run on a central bank? It's a spending run. And we have seen this in hyperinflations. We have seen this during COVID when people run away from currency into goods. So this can happen. That's a run on a central bank, running away from what the central bank have, namely currency, into something that the central bank doesn't have, namely goods. So it's something to keep in mind. And we show that we get a trilemma. I mean, the central bank is committed to price stability. It wants efficiency. Efficiency requires that it invests in these projects and not just in government paper. But you also want monetary trust, that you don't get the people suddenly distrusting the currency and running away from it. And we show that there's a CBDC trilemma. Out of the three objectives, the central bank can only achieve two. So I could explain in more detail, how come, but my time is limited. So let me just leave it at that and maybe get into the discussion. Thank you.
Thanks very much, Harald. So I'm sure that each of you would like to push back against some of the points the others have made. Let's still try to structure discussion going forward. So I'd like to come back to the initial questions I posed, focusing first on the digital euro objectives and design proposals, and then broadening it up to the broader monetary architecture that you have raised and the payment sphere as it evolves and historical questions. So let me start with the digital euro objectives and design plans. Lucrezia already mentioned the three objectives: preserve European autonomy, reduce rent extraction, serve as a robust monetary anchor. So the first question to you would be, would you also, like Lucrezia, subscribe to these objectives as reasonable? And what do you think about whether the design plans, as they're currently phrased, no remuneration, as we have heard, very low holding caps, or even zero holding limits for merchants, are they helpful to achieve these objectives, or might they actually undermine those objectives? And why do we have these restrictions on the architecture as it is proposed? Is this because there is a serious do no harm motivation behind that, or is it because some of you have alluded it's basically lobbying that has led to these restrictions? Jean-Pierre.
No, I have not much to say about this. I think just referring about all the remarks that have been made, I think the payment rationale for having a digital euro is very small, almost inexistent. I think Éric mentioned that we got to get a backstop in case of huge civil disorders and the system, or we have a cyber attack or whatever. And that's the reason why central banks are spending so much money in ensuring that the cash cycle works very well It's in billions of dollars, billions of euros. The central banks, the Banque de France spends billions of euros getting the cash cycle to work. So yes, the backstop is very important, but that's not the reason for having, the main reason for having. So every argument which is based on payments, I think, is moot. We don't need a digital euro for payments, definitely not. The private sector is much better for payment. There is an issue of payment sovereignty. This is clear. It is clear that it has to be solved mainly by the private sector, as Isabelle has said. It is clear also, in my view, that the private sector cannot solve it without the backing of public money. So everything is tied together. The main rationale, again, is to have something which anchors the value of private money. I think we really have to go back to the basics here, okay? We didn't have a system of purely private money for 400 years, and for good reasons. And when we had that during the free banking area in the 19th century, it worked very, very problematically. So it's not because we become digital that the fundamental of money are changing. The fundamental of money tells us that the only way we can ensure long-term permanent stability of private money and singleness is to have it anchored to public money. It has to be there. It may not be present, it may not be used, but it has to be there. That is the dilemma that the central banks have to solve in a digital environment. And it's very much apparent in some of their speeches. It has to be ubiquitous, but not overwhelming. And that's the challenge that they have. And I happen to think that the ceiling is not the good technical way to achieve those dual objectives. I think there are better ways. So I fully subscribe to the very basic justification of digital euro, not as mainly as a payment, and I think the ECB is letting itself a little bit taking out of its main drive and its main objective by arguing on payments. It has to be there as an anchor. Anchor is difficult to manage. My own intuition is that the ceiling system is not appropriate, and the tiering system would be better.
Isabelle, you want to go, or Harald? Do you have an? I think we try to stick to the order, right?
So
Isabelle, please go ahead.
Yeah, thank you, Dirk. So I agree with almost everything that Jean-Pierre said about the so I agree with everything Jean-Pierre said about the objective and the very limited extent to which the digital euro is a response to the payment issue and the sovereignty issue. And I think there is really a risk in the way this project is being pushed forward that we create lofty expectations in the populations that are bound to be disappointed, because ultimately the really key purpose of this is a pretty narrow technical one, crucial, but narrow and technical. So
I didn't say that. But
no, but okay. Maybe but in summary, I think it's a mistake to say we need this to solve the sovereignty problem when it's not going to do that. And of course, everybody is going to realize it's not going to do that. So that's the first point. On the design features, and that's where maybe I differ from Jean-Pierre. But before I go further, let me address head-on this issue of the lobbying, the powerful lobbying of the banks versus public interest. This is completely absurd. The European economy relies on banks for the overwhelming majority of its financing. How on earth is Europe going to finance itself if it has banks that are faced with a major shock in terms of how they finance them? What do you think is going to happen if you get disintermediation? What do you think is going to happen to the availability and the cost of credit to consumers, to corporates, to governments? This is a very profound point, and I find it really counterproductive to frame this debate as, oh, there's the public interest on one side and the bad banks on the other side. We're all trying to make this work without damage to the European economy here. And in that context, talking of remuneration of something that is designed to be a payment instrument, you don't get any interest on cash. And by the way, banks don't get subsidized. When they need to get liquidity from the ECB, they pay a premium over the market rate. And to the extent that there is a remuneration on reserves, it's there to ensure the proper transmission of monetary policy. It's not a subsidy. So I think it's really dangerous, this kind of discourse that pits public interest versus the banks. It is just not the right framing. Having said all this, the holding limit, I think, is an important issue. The way it's been designed, there is a what is called a waterfall mechanism, which means that there is no theoretical limit or practical limit to the amount of digital euro that anybody can have access to. It's just the amount sitting in your bank account is going to be capped. But you can always have more. As long as you have money in your bank account, you can convert unlimited amounts into digital euros. So the holding point is important to limit risks of disintermediation. And frankly, 3,000 is, to my mind, at the high end of the spectrum. Of course, we don't know what people will do. Maybe they won't use it. But in terms of original design, and going back to my point about learning by doing, I think it would be prudent to start with a lower limit and see how it goes, and test the assumptions that are built into this project as we go along, rather than assuming that everything will go okay.
Thanks. Thank you, Isabelle. Éric is next.
Yeah, I mean, on the objective, I mean, I really concur with what Jean-Pierre has said. I think the main objective, I mean, as we say, I mean, it's like anchoring the value of private money, which means, I mean, in very concrete terms, practical terms, it means that to be sure that the value of private money, so how banks convert deposits in other forms of money, is not going to be impaired with very high fees and so on. And you have only two ways to do it. I mean, either through regulation or either through the existence of a public money. I mean, there's no other theoretical way or historical way to that. So either you do it through regulation, so both competition, regulation, that to be sure that banks, which is already the case, I mean, it's very strong, that there's enough competition in the banking sector, or banking regulation to be sure that the fees aren't going to be too high. But I mean, historically, and this is really the history of the US in the 19th century, we tried to do this, I mean, to regulate, to anchor private money only through regulation before having a central bank. I mean, it does not really work because, I mean, regulation is not flexible enough to be sure that you can really anchor the currency. So it's why I really believe in this issue of public money anchoring the value of private money. I also agree that the payment system in Europe is working well. I mean, here we're talking about a retail digital currency. We're not talking about a fast payment system. We're not talking about like introducing PIX or in the euro area. It's very different. So on this said, I mean, on the banks, I mean, I also agree with, I mean, Isabelle, I'm not going to say that the banking credit is useless. I mean, I've written enough paper on the history of banking crisis to show that when there is a very sudden drop in a bank credit, I mean, this is really a disaster for the economy. And on this as well, I mean, historically, I mean, it's very clear that when it happens, even like other institutions, like state institutions, like central bank in the past, saving banks, I mean, state-backed saving banks, I mean, they have a lot of difficulty to step in and fully replace bank credit. So we should not expect too much from this. But that being said, I mean, we're no longer in 19th century banking, and we know that banks are now, I mean, they're mostly funded by market funding, much more than deposits. So deposits still matter, but banks have a lot of flexibility. So a shock on deposits, I mean, it's much less important for the banking sector today than it used to be, which is an argument. Again, I'm not, arguing for full disintermediation, but I think it's also important to take into account this debate.
Éric, merci. Lucrezia is next.
Yeah, I mean, I think I already said what answer to those questions because I follow the script. But I'm happy to see that everybody agrees that this is not a solution for payment. Okay, but this is something that the ECB has been said a lot, And I think they should change their rationale for this project, because it's incredibly confusing. The backstop and the anchoring to public money, of course, is very important. But here is where probably I disagree. I don't know if I disagree with you. I think that really the anchoring is that the wholesale level is not at the retail level. Okay, so this is where this is what preserves the unit of account. Is the settlement asset, which we have to care about. And this is why I wanted to emphasize the wholesale. Now, with the current design, I think this is going to, CBDC, the risk to me is that this is not going to be sufficiently competitive with private alternatives, either tokenized deposit or stablecoin. And if this is the case, I think the ECB is actually risking a credibility issue. Okay, so that they have made a big story out of a little thing, because they have designed it in such a way that by design this is not going to be competitive with other forms of private money. And so then the main question is, how do we preserve the anchor if in the scenario in which this other form of private money, not so much tokenized deposit, because those are issued by regulated entities, by those issues by non-regulated entities, or same regulated not as banks, okay? So the stablecoin issuers. So what's going to happen if this becomes mainstream, beyond the crypto infrastructure? And as I said, I look at the data and I see that this is happening. But 99% of stablecoin using in Europe is in dollars. So if we are serious about discussing sovereignty, this is what we should be discussing about. And so I find this discussion about CBDC largely a distraction, because it doesn't tackle the real issue. And there are two questions. One, whether it is possible to find dollarization in this form, and what should be done to do that. We are in the transition. Okay, we don't know whether this is going to become mainstream or not. So there is a question of how we manage the transition. But if we want to manage the transition, we have to put, in my view, stablecoin at the same level playing field as tokenized deposit. So we have to protect credit, but we not necessarily have to protect banks. And I don't want to be ideological here, Isabelle, but the question is, if we kill euro-backed stablecoin, we are going to be dollarized. And I think this is not going to be very good for European sovereignty. And so I think we should think out of the box. And I think probably Jean-Pierre agrees with me that if we go in the direction of actually provide an ecosystem for euro stablecoin as a firewall against the dollar stablecoin, then we have to think of possibly as euro stablecoin as quasi-narrow bank with access to reserves and lender last resort facilities, because actually what preserves the anchor is the fact that the central bank acts as a lender of last resort in stress, but access to reserves also in non-stress time would allow us to control the monetary transmission in a future tokenized world. We're not there yet, okay? But, we better start thinking about it.
Thanks, Lucrezia. And Harald.
So Governor Chris Waller in the United States famously said that central bank digital currency is an answer in search of a question. And that's probably right, that, that's why the United States, for many other reasons too, moved away from the CBDC. They're not going to introduce a central bank digital currency anytime soon. So what's the rationale for Europe? I don't know. There are large rents somewhere that Visa and MasterCard make. And, I guess the answer to that is regulation. Remove the regulation, then you have other entrants that do that. There are too many US dollar stable coins, not enough European based stable coins. Again, regulation. We have the MiCA We have the MiCA regulation in Europe, the market in crypto assets. It's a step forward. It's much too timid. We need a regulation, a crypto-friendly regulation in Europe that allows European-based stablecoins that goes even beyond the Genius Act in the United States, and the European stablecoins will come.
I've never been in agreement with Harald, but this time I agree with him.
Thank you, Lucrezia. I appreciate
For the
that.
first time in my life. So
Exactly. I was expecting you to disagree with me, so that's why I was checking. Thank you. No, I'm totally on board with what you say. So the euro, the digital euro will not solve that. I'm still excited about it. Why? Because they snuck in the programmability in the smart contracts. This is beautiful. In the future, and I hope they're moving away from the no interest payment, if they also pay interest, and if they pay the interest they're paying to bankers on reserves, why on earth would I want to hold a deposit account when I can hold a euro account and doing all the transactions that I want on my euro account? Isabelle, I don't want to constantly have to transfer the money back to some bank that I don't trust. I have nothing against bankers. They're wonderful people. They have been, they're crucial for the intermediation and all that. They're making large profits. Fine. They get rich. I mean, good. I have nothing against this. But at the same time, like everybody else, they need to work for their money. The future is changing. The bankers will need to work a little harder to make this all happen. They're smart people. I'm sure they find a way. I'm not worried about them. And, things changed. I mean, think about Nokia. It was once a company that that produced the handies that everybody wanted. Nobody talks about Nokia anymore, right? It's gone. So industries change. The financial system will change. This European Central Bank needs to be carefully guiding that process. It shouldn't get into the business of out-competing the private sector, for sure. But saying that the European Central Bank can't do these things because we have to safeguard, the profit opportunities that currently the banking system has, strikes me as a ludicrous thought, with all due respect. So, thanks.
So one point that came up a couple of times is, we have a pretty well-functioning payment system in Europe, not maybe in other countries, but certainly in Europe. So there is not a big pressure to change for that reason. And Lucrezia mentioned, well, maybe one could think about the broader questions, but that's not really what we're talking about right now, which is true. Let me still spend like 2 minutes or 3 minutes on the broader issue, because many people say the ECB should have thought a bit more bigger in that domain, right? So, I mean, let me try to put those two different perspectives. One perspective is the payment system works pretty well. The private sector does this very efficiently, which I'm sure is true. The other perspective is, there's much bigger social costs in having a bank-based payment system than what we can read of the private costs that are internalized by the banking system. So let me give you here one perspective of Andy Haldane, because I think he made it very clear what I have in mind here. He said, actually, on the day he left the Bank of England, on financial stability, a widely used digital currency, CBDC, could change the topology of banking fundamentally. It could result in something akin to narrow banking with safe payments-based activities, segregated from banks' riskier credit provisions activities. In other words, the traditional model of banking, familiar for over 800 years, could be disrupted. While the focus of debate so far has been on the costs of this disruption, largely in the form of disintermediation of existing agents, there are significant potential benefits to be had too. Given the costs of those crises, large and rising, this is a benefit that needs to be weighed. So I guess, again, here the distinction seems to be between the private costs, or the costs internalized by the private sector in the payment system, and the social costs of running a payment system that relies on the stability of banks, which is not God-given, as we all know. So is this a debate that has passed, like Lucrezia suggested, and we should sort of, this is a bygone, or should we still sort of have that debate? Jean-Pierre.
Yes. I think there's a sort of hidden issue. I'm glad that you asked the question. Whether the future cross-border payment system in Europe will be bank-based or tokenized, or a mix of the two. So all the efforts which are currently made to increase fast payment system in Europe, just like they are made in Brazil and India, they are bank-based. So we are thinking, people are building system which allows bank money to move faster cross-border in real time. And you're absolutely right, it works very well. So there may be no reason to change that. But there's an alternative system when you have tokens. Tokens are not accounts, and they are objects which moved on digital ledgers and which could ensure cross-border payments in a very different ways. So it seems to me we haven't yet totally debated this, whether the two approaches could coexist, whether the banks are right in developing, with the support of the central bank, a purely bank-based system. That is a major industrial choice to be made in terms of the future retail payment. And we have to make it. So that's my first point. And I see the banks are very reluctant for good reason, at least for understandable reason, developing a purely tokenized system because they have legacy investment in cross-border payments. Everybody has huge legacy investments, and making those investments obsolete in favor of promoting a new system would be problematic. The second point is about sovereignty. And I said, of course, sovereignty is in payment. It has to be implemented by the private sector. But the private sector has been very slow in doing that. The European Payments Initiative has stalled for many years, and still now it's very much moving incrementally. It needs to be stimulated. We all know that there has been strong lobbying by US payment firms for not moving away from the current system. And some European banks have been very, very sensitive to that. So as much as the private sector holds the key for sovereign payment cross-border system in Europe, it has to be stimulated and it has to be anchored. Sovereignty will be the matter of the private sector, but it cannot happen without a public sector framework, regulation, and incentives, from which the digital euro is a very important issue. So I wanted to correct that. And then on programmability, this is an issue that Harald has raised twice now. And I think we should be very careful about what it means. I'm very much in favor of programmable payments, meaning you have algorithms which trigger automatically payments once an oracle on a blockchain or a DLT has deemed it necessary. But the payment instrument itself has a value which is absolutely unchangeable. It's not the value of the payment instrument should not be programmable. That is the contrary of money. Money has a stable value. It is totally information insensitive. Once you introduce information sensitivity in money, it's not money anymore. So programmable payment, yes. Programmable money, the kind of welfare payment you get, but you cannot use for going vacation or paying for alcohol consumption. No, that is the end of money. If we make money itself with a value which is dependent, state contingent and dependent on circumstances or an algorithm, we have no money anymore. So I just wanted to introduce that distinction. And from that perspective, I think the digital euro should be absolutely ironclad. Its value should not be subject to any circumstances. So it's a contribution to having a programmable payment system, just as other private monies are. But I would be very, very reluctant in the idea that the digital euro itself should be a programmable unit of money. Thank you.
Thank you. Isabelle.
Thank you. So let me just come back really quickly to two things that Éric and Harald said, and then I'll follow up on the design issue that Jean-Pierre touched on. So I'm not worried about bankers' profitability or the future of banks. I'm just saying that in a system where deposits still represent close to 40% of banks' funding in the Eurozone, and you reduce that or you substitute it with more costly funding, this will have an impact on the Eurozone economy. And this is something we need to take into account. That's all I'm saying. Now, Jean-Pierre, you said, will the future of cross-border payments be bank-based or tokenized? I don't see it that way. Actually, the banks, maybe not all of them, but certainly the one I work for, we're very keen on tokenizing the services we offer.
Yeah.
And
I say, oh, a mix of the two.
Yeah. But that's why we need the wholesale digital euro. We need a tokenized settlement asset, and that's the wholesale euro. And then we can move, very quickly to develop not just the cross-border side of things, all the services that a bank or frankly an asset manager provides can be, or a securities services provider, all of that can be tokenized, but we need a settlement asset, and that's the digital euro. Yes, there are large infrastructure costs, and that's why we need to be mindful where we spend the big infrastructure bucks on this, or some features of the retail euro. And I would argue, actually, from a standpoint of euro area sovereignty, and that's a point that Lucrezia has made as well. The big challenge is the wholesale ecosystem. It's the dollarized stable coins. And to me, the best answer to that is precisely tokenized bank deposits and tokenized bank services. And for that, we need the wholesale digital euro. Now, there will be remaining, use cases for stable coins. I mean, in particular, the retail digital euro is not going to be a cross-border instrument. So maybe you want to have euro-based stable coins to handle that piece of the puzzle. Again, there is the whole ecosystem of finance and payment system is going to evolve. Competition is good. This is not about being against competition. We just need to be thoughtful about how we go about this to avoid unintended consequences. I think ultimately is how I see it.
Thank you, Isabelle. Éric, please.
Yeah, 2 points. I mean, first, the first one is that on payments. I mean, the objective of a digital euro for payments. I mean, we said that we agree that the payment system is working well, and that's not the main reason for digital euro. I mean, I should emphasize that there's still the issue of sovereignty in means of payment. I mean, that's another very important justification for the digital euro. So the payment system in Europe is working very well, but it highly depends on US companies. And on that, I really think that introducing the digital euro in a way that is not going to be fully dependent on the same US companies, so this is where the devil is in the detail today, is extremely important. So I would not say that in terms of fast, I mean, the speed of payment, I mean, it's efficient. In terms of sovereignty, it's not efficient, and there is a need for digital euro. For stable coins, I mean, for the reason that we have said that I mean, the payment system works pretty well, I don't think that we absolutely need stable coins for domestic payment in Europe. And stable euro-backed stable coins, I mean, they will not by themselves solve the issue of sovereignty. So the only interest of the stable coins today, in terms of payments, I mean, they are mostly used for collateral, I mean, today, so it's another thing. But in terms of payments, are for international payments. And on this, I mean, what I've been arguing before is that it's very important to have this wholesale digital CBDC that will allow banks to connect from one country to another through their tokenized deposits and so on. And on this, it's very important. I mean, it already exists within the European Union between a country with a euro and country without the euro. It's working pretty well. I mean, to do bank transfers between Denmark and Sweden and other European countries. I mean, that's going to be a bit more difficult in terms of diplomacy and politics to implement with non-European countries, because you need to agree on an exchange rate and exactly how to set the exchange rate at the exact time. But I think it's very important if we want to maintain, again, sovereign means of payments today. And instead of having, international payments only intermediated by companies that can apply their own fees and their own conditions without any kind of oversight by regulators in the public.
Thank you, Éric. Lucrezia.
Yes, I mean, the alternative to bank-based payment, cross-border payments is tokenization, as Jean-Pierre said. And I think this is a very interesting technology. I think it will flourish. And I think there are two ways in which it can flourish. One within the banking sector, tokenized deposit, or outside the banking sector, and that's stablecoin. Now, what's going to happen is difficult for us to determine, okay? So we can design a regulation like MiCA, which massively favors tokenized deposit over stablecoin. Good luck, okay? Because, this is where, the regulation cannot really reach because, basically the dollar-backed stablecoin is fundamentally offshore, and so it's a little bit like the euro-dollar market. It's going to be very difficult to regulate to a centralized approach like the MiCA approach has by putting all kind of unfriendly things on remuneration or on the composition of reserves and so on. So what's going to happen, will be mostly, the effect of competition. And so, maybe Isabelle is right that the banks will be very good at developing this technology. My understanding of banks, having been in board of banks for many years, is that they're very slow, okay? Of course, BNP maybe is different, but, they're very slow at developing, there is a lot of legacy, technology, and so on. So it is likely, okay, that these private issuers, non-bank private issuers, will actually flourish. And given the European regulations, I'm now repeating myself, it's going to be dollar-based stablecoins that will flourish. And, this is, I go back to my fixation, is what is the infrastructure dollarization that I think the central bank should be mindful of, because this is where the danger is to lose the anchor, the public anchor, which I think is very important. And, okay, so how do we want to do it? I mean, we want competition. I'm with Harald with that for once, but at the same time, we want to embed this new stuff into a system in which we can preserve the public anchor. So how to do that? There are, I think that we should be more friendly to the private issuers. We should let them compete with banks. That's going to be also good for banks. What's going to happen, we'll see, okay? So that, okay, that's my view.
Thank you, Lucrezia. Harald is next.
Yeah, I fully agree with Lucrezia. I mean, we need a regulation that allows euro stable coins and just opens up things more. Now, on the question of the payment system, let me maybe clarify one point. Settlement between financial institutions is always done via central bank reserves. Whether you call that reserves, or whether you call that wholesale CBDC, or whether you call that retail CBDC, that's just different flavor. All of these things are central bank liabilities. And as Lucrezia pointed out, what we want to keep happening in Europe is that the settlement is happening in ECB reserves and not in US reserves. Once the US stablecoins take over, the settlement happens in reserves of the US central bank, not in terms of the European central bank. And that would mean loss of monetary control by the ECB. And I totally agree that that's a danger that we should foresee. Tokenization by itself, in my mind, has very little to do with this. So let's say Deutsche Bank issues tokenized deposits. And I have a tokenized deposit. Of course, I can give it to Éric or I can give it to Jean-Pierre. But if he wants to cash it in at his bank, or maybe I give it to Isabelle and she cashes it in a PNB. At that moment, there has to be a transfer made from Deutsche Bank to PNB. And that's done in the way it's always done. If I make a transfer now from my bank account to Isabelle's bank account, then my bank will have to sell some assets and will have to instruct the ECB to send reserves over to Isabelle's bank in order that the liabilities match the assets. And that's not going to change. I think that's a fundamental structure. Now, once you have a retail euro, of course, then we could make the settlement directly. We could directly settle in the central bank reserves. You don't have to go via the circuitous route of going via the bank intermediation, that you don't need the backroom to settle it all. So it may be quicker and simpler, but it's ultimately the same settlement system.
Time is running fast. As usual, I underestimated how quickly this would go. We have, I think, 3 sets of questions that I would like to raise. Of course, we will not be able to do this. So I suggest that you pick whatever you find most important. Let me just outline them, and that would be the last round for each of you. One set of questions concerns implementation, which is important, right? I mean, how do we roll this out? how are responsibilities divided between the public sector and the private sector when we implement these ECB plans. Some people say as much as possible to the private sector, it's doing it more efficiently. Some other people say dangerous, there's conflicts of interest. You know, banks are very still heavily reliant on US dollar markets and therefore indirectly exposed to US pressure. So there's a trade-off, it seems. Another set of questions is the broader context, which many of you have already now touched upon. You know, how does this project as it is fit into whatever is changing out there, the BIS initiatives, the wholesale deposit tokens, stablecoins. We've mentioned it quite a bit, but maybe some of you want to take up this point once more. And the final set of questions that I would have imagined is, you know, looking forward, going forward, what do we expect to happen now? Is this going to fly? Is this going to be adopted? Is it going to achieve the objectives? So please pick whatever you deem most important from these three. And it would be great if we finish around, say, 35. So maybe you can keep it to a few minutes. Jean-Pierre, please.
Yeah, thank you very much, Dirk. Two points. First, on sovereignty, I very much agree with Éric. Retail payments are a problem of sovereignty. The reason is because of data. At the moment, all our data on our payments are actually migrating to the United States in a total contradiction with what we are doing with our data privacy regulation. And there's no way to avoid that because those payment systems are managed by US operators. I remember 5 years ago, a letter written by the former Chancellor of Germany, Angela Merkel, and a few prime ministers of Nordic. And they had that sentence, data is the new currency. I think it's technically inaccurate, but it gives you a feeling of what is actually the joint sovereignty problem of having data and retail payments under European control. I think it's a very important question if you care about sovereignty and data. My second point is about the broader context. We have to speculate on the future. I would not expect dollar stablecoins to take hold in Europe anytime soon. I think dollar stablecoins may be a threat for emerging economies with a fragile monetary regime. I don't think we are exposed to that right now. I think, again, what's at stake is that our retail payments are foreign dominated. I could reversely see the tokenization and the digital euro as a way of expanding the international role of the euro. I think we have, in the current circumstances, there is a big question whether the euro will expand its international role if there are doubts on the other dominant currency in the world. And that will test a little bit the current approach of the ECB. We are not in favor, but not against the internationalization of the euro. I think the interesting question is how this delicate balance will be maintained when we move to tokenized money. Thank you very much, Dirk. I hope I haven't too long.
Thank you. Isabelle, please.
Thank you very much, Jean-Pierre. I think I'm sorry to say, but I think you missed a big shift in the ECB's stance. The ECB is now officially for the internationalization.
Even better.
Of the euro. And I agree with you, actually, that the tokenization can be an additional instrument to that end. But what we're talking about here, again, is the wholesale digital euro. The retail one doesn't have any international dimension, but the wholesale piece. And I think it's interesting in what we in what we've all said. We seem to converge around this notion that the financial system looks like it's going to evolve in the direction of tokenization, and that to retain sovereignty in that space, having the wholesale digital euro will be important. Having said that, almost certainly the retail piece will proceed as well. I think we've all said that historically the private sector has been playing the lead role in operating the payment system, and for me that makes sense. And I think both from the standpoint of sovereignty and from the standpoint of efficiency, the initiative that is being ramped up at high speed by the European Payment Initiative, this consortium of banks, is something that deserves to be given its chance and support. I mean, on current plans by by the end of the year, it will cover, more than 140 million potential users. So it is really gathering pace very quickly. So that shouldn't be disregarded. And then the last point I've said is there are high ambitions, and that's great, but there are also high risks of destabilization. And I would say, even when people give the go ahead to the project, it's probably not a good idea to try and cast in stone at that point all the features, all the elements, and going instead for a kind of phased rollout where we allow quite a fair bit of learning by doing, and reconfiguration could be a more prudent approach.
Thank you, Isabelle. Éric.
I will just focus on the point you made about the project of the BIS on connecting central bank reserves or wholesale CBDC of reserves across the world, because I think it's really a very important issue today. I mean, and it's related to what I was saying before about how to improve international payments and avoiding stable coins or other kind of private money with a strong US dominance or with very high fees like some service providers today. And I mean, it's true that we live in a world where domestic payments are settled by central bank reserves, but international payments are not. And so now there are all these initiatives to also allow a lot of much more international payments to be settled by central bank reserves. As I said before, I mean, it's difficult in terms, I mean, technically it's not so difficult. I mean, the BIS and other central banks have always made a lot of progress. Then in terms of politics, it's a bit more difficult because then you're reaching the issue of, the exchange rate, capital control, and so on, because there are many countries. So there's a lot of discussion involved, but for me, that's one of the most interesting issues right now for international payments and new forms of money.
Thanks, Éric. Lucrezia.
So I'll tell you how I see the future, okay? So this, not now, the future. So I want, the digital reserve, I want reserves which are already digital to be, the wholesale system of the ECB to be upgraded. So I want, so I think the future will have, tokenized reserves, okay? So, and I think we will have a hybrid system in which we will have euro-backed stablecoin, tokenized deposit, and retail CBDC. Depending on the design, CBDC retail will be small or large. If with the current design, I think it would be largely relevant, but if the design will change, then maybe it will compete with with private form of money. In this system, euro stablecoin, we want to flourish it together with tokenized deposit, and we want to make it safe. So we will have to give it access to reserves, remunerated reserves. And we want to give lend or last resort facilities to these issuers. So this will allow to embed it into the system. I think this is important because this is the only condition at which we can prevent dollarization. And I think, unlike Jean-Pierre, that the danger of stablecoin, you can see it already in the data, not in the retail payment, but in the infrastructure, collateral, liquidity, and so on. And so this is quite important. I think that if we can manage to have this system with the wholesale, which will guarantee interoperability with the private system, as well as connection, these corridors with other central banks for international payments with other central banks. I think this would be good for the international role of the euro, and will also probably be good for the saving and investing union, because as long as you get away from the banking structure, you also get away from the home bias, basically. And so that's my vision.
Thanks for this vision. Harald.
Yeah, I'm excited about the digital euro because of the possibility that it bears. I mean, again, I think the most interesting part to me are the programmability and the capability for smart contracts. I hope the ECB, now that they've put so much work into this thing, is going to make it success. It's by no means guaranteed. Ultimately, that will mean removing the holding limits. Ultimately, this will mean paying interest on the CBDC. My prediction is this is going to come sooner or later. And then, sure, then the digital euro will give banks a run for their money. There will be competition for deposits. That's good. It will make the world a better place. Bankers will become creative and find new things to do and find ways to improve allocations and find ways to improve intermediation. And I'm very much looking forward to that.
Thank you. So now this round was actually rather quick. Thanks so much. And I apologize to the people that have commented in the chat. I think we sort of didn't find an opportunity to answer those questions. Sorry about that. I thank all the 5 panelists, Jean-Pierre, Isabelle, Éric, Lucrezia, and Harald. I thought this was very interesting. We'll see what will happen, and I wish you all the best. Thanks for joining.